Welcome back to QAVTK. This is episode 802. We're recording this on Tuesday, the 14th of January, 2025. Tony, do you want to get into your Horizon Oil pork?
I do. Yeah, it was a really interesting one. I decided to do it today because it's an oil company and the oil price has turned up. And there's a number of shares on the buy list which have been there almost as long as we've been doing QAV, or if they haven't been there the whole time, they've gone on and off the buy list a lot. And I know I did a pulled pork on Horizon. I couldn't find out exactly when, but I suspect it was in the very early stages of QAV. So I'm happy to revisit it now. And it was a very interesting one. It was a bit of an eye-opener for me. So I was glad I jumped back in and had a look at it. So if anyone doesn't know who Horizon Oil are, I'll quote from their website. They're obviously an oil company. They drill and explore and sell petroleum products. To quote them, we have a low-cost conventional oil production from joint venture interests in, I'm going to go through how they name things, Block 22-12, which is in offshore China, and Horizon's partners are CNOOC, CNOOC Limited, Fosun International Limited, which is via Rock Oil, another Australian company, and Oil Australia Limited. That's one of their areas that they work in. So all these names relate to oil fields. So Block 2212 is off the coast of China. PMP 36180, which is also called the Mari Manaya fields, which are offshore New Zealand. And Horizon's partners in that are OMV and Q Energy Resources. And both Rock Oil and Q Energy will be familiar with investors. They're listed on the ASX. And the last one that Horizons call out is OL4 and OL5, otherwise known as Mereenie in the Northern Territory, Australia. And in that case, their partners are Echelon Mereenie, Central Petroleum Mereenie, and Q Energy. In both of Horizon's non-operated oil projects, Block 2212 and PMP 36180, Horizon has been a long-term partner, over 20 years in China and 17 years in New Zealand, and was a participant prior to and throughout the project appraisal and development phases, including the 2022 Block 2212 12-8E development. So basically, their expertise is in finding and bringing oil fields to production. I wouldn't think they have the capital to do it themselves, so they partner with other people, and then sometimes they step back and let other people do the actual drilling for the oil and selling for the oil, and they keep a stake. So that's what they do. 2024 results were down on prior years. So revenue was 111 million US versus 152 million. Profit after tax was 26 US million versus 44 million in the prior year. However, FY23 appears to be an outlier with much bigger revenues than trend. And management called out that FY24 was 7% above the 5-year average trend. And if you look at a graph, the prior year was quite good, but otherwise they'd be chugging along on an increasing trend, but not quite as good as FY23. One thing that has happened between when I last looked at this company, I think, and now is a scandal engulfed the company in 2020. And I'll call it the PNG scandal, and I'll be circumspect about what I talk about because the parties in the matter have been litigious, and I think there may still be some actions going on, so I'll be careful. Anyone interested in the details can go online and read articles in the Fin Review and other places, and also the company's responses to them. But using the company's own announcements, the timeline goes like this. On February the 10th, 2020, the AFR published an article suggesting that Horizon may have been involved in the bribery of a PNG energy minister. The claim relates to the granting of an exploration license back in 2009 and subsequent company transactions between the business granted the exploration license. At the time, the Horizon board suspended the then CEO and commenced an investigation by external law firm Herbert Smith Freehills and accounting firm Deloitte. This was announced to the market on the 12th of February 2020, so 2 days after the Fin Review first broke the story. The Horizon CEO then resigned on the 28th of February, and they appointed an internally sourced acting CEO. On the 9th of June 2020, the Horizon board announced the independent investigation concluded and found no breach of foreign bribery law. On the 25th of June, the board announced the interim CEO would become the full-time CEO. So that's a précis of what's happened. People can read about it online. I'm not going to talk about it publicly, and just in case I say the wrong thing. I will say, to my knowledge and research today, no charges were ever brought against the company over the matter. So if there was, well, the allegations haven't been proven in a court of law, I guess is where I'm coming from. The company share price closed at 13 cents on the 31st of January 2020. And then when the story broke, it dropped to 8 cents during February. So quite a drop. But proving a good time to buy, because since then it's rebounded and the price today is 19.5 cents. It's hard for me to know whether that was in response to the bribery allegations article or COVID, because COVID was also occurring around then. And if people remember, the oil price was smashed. It got down to about $45 a barrel at the time. So I would have thought this was one of the companies that was on life support during that period. So the share price may have been hit by COVID as well. The Horizon board thought 8 cents was too cheap and began a buyback of their shares. And that went through for 12 months up until a fund called Samuel Terry bought a 19.9% stake in June 2021 when the price was still only 9 cents. On the same day, a company called Australasia Energy sold down its stake from 30.26% to 25.34%. So a bit of corporate action going on when the price was still depressed, and probably coming out of COVID as well. I went looking to see what Australasia Energy does, and I couldn't find a website for them, even though there's listings for a website for them that just goes through to a file not found error or a site not found error. The only information I could find on them was from a site called Zoom Info, who I've never used before, but they say Australasia Energy has more than 33 years of industry experience and has developed close working relationships with major oil and gas producers, major energy consumers, government officials, and policymakers, etc., etc. They work with BHP and various other big companies in the oil and gas sector. However, I also saw listed on Stock Doctor that the Austral Energy ownership is the same as ones which Stock Doctor lists as owned by US funds IMC Investments, and they own 24.68%. So I went to the annual report, and it actually says that these two are working as partners. So I suspect that you can interchange both of them. I looked up who IMC Investments are. They make the boast that they are a global trading, powered by quant research and tech company. From Amsterdam to Chicago, Sydney to Mumbai, IMC is where the brightest minds in quant research, tech and trading come together to solve our industry's most challenging problems. We hire the most exceptional people, then unleash their potential by giving them access to disruptive, cutting-edge technology, including AI, machine learning, and large-scale computing. Well, they could have just used QAV to go and see how good Horizon Energy was at the time. So I think my reading of this is Austral Energy and IMC are interchangeable as the fund. Either way, they own nearly 25% of the company, and Terry Funds owns, I think they're now sitting on about 21%. So between them, they own almost half of the company. In November 2021, in the AGM address, the acting CEO, who was made the full-time CEO, kicked off his presentation with the very first slide, which says, "Our strategy is simple. Firstly, we seek to maximize free cash flow. Secondly, we intend to make further distributions to shareholders when it is prudent to do so. And thirdly, we will consider to invest in new business if exceptional. So I suspect there's a bit of an influence of the new fund managers who control the company behind that strategy. It's basically a maximizing cash flow strategy. And it reminded me of the company we spoke a couple of weeks ago, the Traffic News Network company, where a fund manager took over and said that he wanted to make sure the company was aligned with shareholder interests. Going on from that, and I like that. We're interested in cash flow as an investor. I think it's great. In the first half 22 results, the focus on cash flow was underlined. Cash flow from operating activities increased 150%, replenishing cash flow following capital returns. So that was interesting and made me think about why they had to replenish their cash flow or their cash from capital returns. And I looked at it and found out there was capital returns made in June 2021 at the time that the fund manager, Samuel Terry, I think they were called, bought into the company, and also in June 2022. And both of those returns totaled 3.35 cents per share. And that was on top of dividends of 1.65 cents per share. So in the 12 months after this fund bought in, they got 5 cents per share returned to them. And they bought in between 8 and 9 cents. So that was not a bad return for them. Kind of operating or cash flow return of 1 or 2 maybe. So by 2024, I worked out, April 2024, Samuel Terry had repaid its initial purchase price and distributions from the company, at least on a pre-tax basis. I know capital returns are taxable and dividends are taxable, etc. But in the following shareholder presentations, maximizing cash flow has always been listed as the top priority. The company has kind of shifted, not just to maximize cash, but also they didn't undertake drilling programs for a while. And the company has a long history of drilling and finding good areas to productionize and then partnering with people to bring those areas to fruition. But they did start drilling programs from 2022. So they understand they need to keep their future reserves up because they will run dry otherwise. But obviously doing that within a cash flow mindset, I guess, has been good for them. Horizon replaced the CEO in 2022 and also a large part of the new management team. And also last year refreshed the board. So the announcement in 2024 was Horizon chairman to retire, board to refresh. So after almost 6 years as Horizon's chairman, Mike Harding has advised the board of his intention to retire at the conclusion of the upcoming 2024 Horizon AGM, which was the last AGM. It is with mixed emotions that I announce my intended retirement from the Horizon board at the upcoming AGM. Horizon is a company I've grown very fond of, having taken on the role at a time when the company was deeply indebted and facing severe strategic headwinds, which had eroded shareholder value. He goes on to talk about turning the company around, which was fantastic. And there was another comment which I wanted to just highlight. I'll just see if I can find the actual quote. Anyway, I can't find it. They talk about the company becoming a can't see it. They're talking about the company becoming a like a cash generating oil production company, which is a bit of a different sort of spin on their prior mission statements. So over the course of a couple of years, they've cleaned up the bribery scandal, alleged bribery scandal. They've become a cash flow focused company with disciplined exploration. And it all has the hallmarks of these two funds setting about to change the way the company operates. And the share price has recovered from 88 cents to nearly 20 cents. So it's worked well for them, and it is working well for them. What else can I say? So that's pretty much where they are. It does remind me of that Australian Traffic News company we spoke about, where a fund takes control and then positions the company for shareholders rather than anybody else, other stakeholders like management. QAV numbers. So put all that aside, that's background. ADT is $178,000. So it's not a large company, but it's suitable for people with a portfolio of around, say, 500,000 or less. The share price for analysis is 19.5 cents per share. There is no consensus target for this stock, which is something I like, and no forecast earnings per share, so I can't do an IV2 calculation for it. IV1, however, is only 13 cents, which is below the share price, so we can't score it for that. Current yield I found interesting. This company is really being milked for the shareholders. Current yield is 15.38%. So that scores well for us, which is very strong, but the payout ratio is high. And Stock Doctor report a payout ratio of 116%, meaning that the dividends are being paid out of cash reserves, not just current profits. So, my analysis of that is that if the future results are not materially better, the dividend would need to be cut. So just be aware of that if you require that kind of level of dividend. This is one of those companies which I like, where the yield is greater than the PE ratio. That's a strong value signal for me, and we score it additionally for that. Stock Doctor financial health is strong, and the trend is steady. Stockopedia quality ranking is 80, which is not all that high. The F score is 4 out of 9, which again is just below par for that. If drilling down into the F score highlights some of the risks mentioned above. Profit this year is lower than the prior year, and there has been some increase in debt. That didn't trouble me because the company's got lots of cash to service debt, so I'm not too worried about that, but it does lower the F score. Stockopedia quality ranking is 80, but value is 95 and overall is 96, which is quite high. So I think Stockopedia rank it pretty well as well. We don't score based on ROE, but it did strike me as quite high. ROE for this company is 31%. That's the return on equity. So that's very good. PE ratio is 7.6 times, which is low. It's not the lowest, though, or the highest, but it's the second highest. And the highest was 3 years ago. So unless the PE sort of stabilizes, next half it may become the highest and it won't receive a score for it. We're not scoring it now, but it may get a -1 in the future. What's really driving my liking of this company is the prop cap, which is 3.27 times, which is very low. So it is throwing off lots of cash. And so bang like a drum, but it's something I like to see in companies. Net equity per share is 8 cents per share, so it's well below the share price. We can't buy it on the basis of its assets. We're buying a cash-producing machine instead. Interestingly enough, two funds hold nearly the majority of stock between them, in the sort of mid-40%. But I can only see one with a director on the board who's, I imagine, driving this move towards cash flow. So it was a tricky one to score as an owner-founder. Strictly speaking, it's not. However, clearly the company is being run for the benefit of the shareholders, so I'm going to leave it as scoring a 1 for owner-founder. It seems to be well stewarded by the shareholders, by the large funds involved, but not an owner-founder. What else can I say about it? Company share price has been increasing kind of steadily since 2020, so it doesn't score as a recent 3-point trendline buy. It's been a buy for a long time. It doesn't have increasing equity, so we can't score it for that. But overall, it's a 10 out of 12 for quality, which is 83%, which is very good, and a QAV score of 0.25, which is at the top of the buy list. So it scores well from our perspective. Now that oil is now a buy, it can be bought with some confidence anyway, or looked at. I'm not suggesting people run out and buy it, but have a look at it. There are some risks, of course. The high concentration of ownership in two funds so far seems to be very good for the company, but I always wonder if push comes to shove, the small investors' interests may not be top of mind for the other fund owners. The other risk is the high dividend payout ratio. That's going to have to resolve itself. It can't go on forever, which is probably going to mean a cut to the dividend payout. But it's got to be careful of companies like that. The other thing which I found interesting was that the company is only producing, or its share of the production is $111 million in revenue. So it's a fairly small company, and it will have to fund large capex at some stage to keep exploring. They seem to have a disciplined methodology for that in exploring around their current tenements. So they're trying to minimize the cost of doing that. But $111 million of revenue is not a lot. And I'm often a little bit wary of small revenue companies because in bad times there's not much meat on the bone to have in reserve. But at the moment, it's doing well. The last risk is, of course, the oil price. It's moved to a buy, and as we said before, there may be a glut coming up into the market if Ukraine gets sorted out, or if drill baby drill happens as expected, or any number of other geopolitical events and risks occur in the next few years, which will affect the oil price. And as we know from our experience, it happens reasonably commonly, sort of once or twice a year, perhaps. On the positive side, this company, even though it only had $111 million in revenue, produced $39 million in profit before tax. So it's highly profitable. So even though I said before it doesn't have many reserves, it's got a big fat profit margin to play with if there's a problem. And that to me says it's also leveraged to the oil price. So it's a bit like one of these gold mines where the costs are fixed, and when the gold price goes up, the margin improves. I suspect that's probably the same with Horizon Oil. So yeah, colourful company, interesting situation, being managed for cash flow, which I like. So have a look at it, people.
Thank you, Tony. And I added some to one of the live portfolios yesterday just for transparency.